futures were up 9 points. Stocks advanced and bond yields dropped as fresh signs of an economic slowdown prompted investors to ramp up bets on interest rate cuts next year. This week's soft inflation and jobs data in the U.S. has fueled the conviction that aggressive policy tightening cycles from the Federal Reserve and other central banks are finally at an end. That view helped drive $23.5 billion in stock funds in the week through November 15th, the second biggest inflows of the year. If bonds had been largely on the move through the CPI data, they are more likely to favor a less directional range until the first full week of December. General range trade block float thoughts are the closer rates are to the recent lows, the more it makes sense to consider locking being closer to recent highs without blowing through them due to an obvious catalyst that allows for subjective decisions. Housing starts rose to 1.372 million versus 1.346 million in the prior month. That's up 1.9%. It was up 3.1% previously. Despite the conflict in the Middle East, oil is showing signs of healthy supplies and rising stockpiles, and crude prices are on the run for 4 straight weekly declines, the longest streak since May. Lower oil prices as we head into winter means lower prices at the pump and lower heating oil bills, which is good for the fight to bring inflation down and good for rates. Most people just take that extra money and go buy crap. The National Association of Realtors reports that listings are increasing as mortgage rates fall. The rate lock-in effect, which basically says that people are unwilling to move when that means trading a 3.5% mortgage for a 8% mortgage, appears to be easy. Median listing prices are holding up, although it sounds like some of the Western markets, which rocketed during the pandemic, are seeing some more price cuts, more so than other other places. Median listing prices are up 0.7%, new listings are up 6.7%, active listings are up 0.6%, and time on market is down 2 days. National Association of Realtors chief economist Lauren June forecasts that existing home sales will rise 15% in 2024 as mortgage rates fall into the 6 to 7% range by the spring selling season. Based on normal MBS spreads, a 4.4 10-year yield, which is about where we're at right now, should translate into a 6.4% mortgage rate. The 10-year Treasury yield is at 4.4%, which historically means mortgage rates could be around 6.4%, but they are much higher. The bond market is forcing the Fed to pivot. With essentially nothing meaningful on the economic calendar, the bond market did a good job to sticking to a logical script of more sideways and less volatile. It remains to be seen if that script will remain in force all the way until the first full week of December, but there's nothing in terms of scheduled events that promises to derail it. The only exception might be a weird trading dynamics occasionally seen on the Thanksgiving week, but those must be taken with a grain of salt, pronounce a gravy, until being confirmed or rejected by more active markets in the following weeks. All we know is right now, this was a solid week that ended on a solid note. It's closed the day down pretty much flat. It was down 3 basis points on the day at 101.20. The Ginnie Maes were about the same. So at 101.20, that is putting us just above this 100-day moving average, which is the purple line in a Fibonacci as a floor. And then we have the ceiling up there at another Fibonacci at 101.633, and the 200-day moving average is converging down on that. In other news, there are a big court case coming up. The CFPB claims that Citibank held secret policy against Armenian Americans. They are alleging that between 2015 and 2021, the bank's secret statewide policy in California resulted in the rejection of credit card application, rejection of requests for increased credit lines, and outright cancellation of accounts in good standing. Applicants with the last names ending in IAN or YAN or applicants living in Glendale, California were targeted by this practice. That's some dicey stuff. Looking at next week, we don't have a ton of stuff on the agenda because it is a short week, and it's just how it falls out. Monday and Tuesday, there isn't a ton. We do get jobless claims on Wednesday and durable goods order and core capex as well as consumer sentiment. And then on Friday, we do get, even though the bond market is closed, we do get the S&P Global PMI. So if you have